Right, so we start chapter 8 here in our quest to find the truth about accounting. So here we're going to talk about measurement of inventories. And so first thing we have to figure out is when we're doing this, before we even figure out how to measure inventory, is to define what is our inventory. So inventory refers to the assets a company intends to sell in the normal course of business, has in production for future sale, or uses currently in production of goods to be sold. And so it's things that the company uses to create revenues. So for example, they have Hewlett Packard. Hewlett Packard makes computers primarily. Now, certainly they use computers in their business, certainly for all kinds of things, but basically they distinguish here between the computers they intend to sell, those they make, versus those they utilize in such things as accounting and other stuff, management, purchasing, you name it, risk, all kinds of things. Those things are not inventory because they don't intend to sell them in the normal course of business. They're going to use those in their business to help run the business, certainly. But those are not listed as inventory. They're listed as part of property, plant, and equipment, specifically equipment. Now, we account for the sale of inventory as an expense item that's related to the inventory, and that account name is called cost of goods sold. Now, the type of inventory a business would have depends on the nature of its business. And so there's two distinctions. First, you have merchandising companies. Those companies are wholesalers and resellers. They don't make the things that they sell, they buy them from manufacturers. And so these are purchased, not produced by the merchandiser. And the cost of the merchandise inventory includes the purchase price plus any other costs necessary to get the goods in condition and location for sale. So you might have, insurance costs, freight costs, things like that. For manufacturers, they have manufacturing inventory. Those consist of three types, categories of inventory: raw materials, work in process, and finished goods. Now, these are goods that are produced by the manufacturing company themselves, and of course they're sold to retailers, wholesalers, possibly other manufacturers. Um, Going back to the Hewlett Packard example, uh, Hewlett Packard makes computers, but they buy, for instance, Intel processors from Intel. Those processors that Intel produces were finished goods for Intel. Well, they become part of raw materials inventory for HP. So raw materials represents the cost of components purchased from other manufacturers that will become part of the finished product. And as I mentioned, the example they use here is computer chips and memory modules that will go into the computers produced by HP. Work in process refers to the products that are not yet complete, but have begun the process towards completion. It includes the cost of raw materials, it includes the cost of direct labor, and this thing called manufacturing overhead that we discuss heavily in both managerial accounting as well as cost accounting. And so anything that's partially completed, whether it's 1% or 99%, is listed as a part of the work in process inventory. And of course, if it's completed, it becomes part of the finished goods inventory. It's ready for sale, but not sold yet. And so manufacturing companies can do this a couple of different ways as far as disclosures of inventories. They can disclose it either in the notes or directly in the balance sheet, the dollar amount of each inventory category. It's the choice of management on how they want to present that, as long as it is presented somewhere in the notes or directly in the balance sheet. So you may remember this from your managerial accounting days. Again, you have raw materials, direct labor that are contributed to manufacturing goods, as well as these indirect items that fall under manufacturing overhead. These components become part of the work in process inventory, and once the work in process inventory is complete, it's passed on to finished goods inventory. Once they're sold, the finished goods are sold, they become part of cost of goods sold. If anything not yet manufactured or sold yet become part of ending inventory. There's a couple of ways you can establish an inventory system. It can be perpetual or it can be periodic. With a perpetual inventory system, and more companies are going to such systems because of the ease with establishment of such system, plus the efficiency that it gives management to determine where they are as far as their inventory levels, their inventory costs, and such things as that. Perpetual inventory systems are becoming more and more prevalent, much more so than periodic systems. I think a couple of reasons why. Electronics such as electronic cash registers, RFIDs, barcodes, things like that, make it much easier to track inventory for most companies. Anyway, the perpetual inventory system continually adjusts inventory for each change in inventory caused by a purchase, a sale, or a return of merchandise by the company to its suppliers. As far as the related cost of goods sold account, each time goods are sold, it continually adjusts the CGS account for items sold as well as items that are returned by a customer. And again, the reason why management would want a perpetual inventory system is because it allows them to determine the amount of goods they have on hand at any date, as well as the number of items sold during a period. So they can check sales results by category of inventory. They can determine what inventory they still have on hand, whether or not they need to purchase additional items, less items, things like that. They can track what items are selling, what items are not selling. So here we have an example. This beverage company purchases soft drinks from producers and then sells them to retailers. They begin with an inventory of $120,000 on hand, and during the year of 2018, they had purchased an additional amount of inventory costing $600,000. So essentially what they have is, during the year, is they have $720,000 worth of inventory available for sale. Sales for the year total $820,000, and the cost of the soft drink inventory sold is $540,000. So that means of the 720, they've sold 540, meaning they have 180,000 left in ending inventory. And so certainly when they purchase inventory, they're going to debit directly to the inventory account, and assuming they're purchasing this on credit, the corresponding credit is to accounts payable. As far as when they sell items, the cumulative effect is the following: debit $820,000 to accounts receivable and credit $820,000 to sales revenue. As far as the second part of this, the cumulative effect is debits to cost of goods sold of $540,000 and credit to inventory of $540,000. Now, periodic inventory system, the reason it's periodic is because you adjust the inventory account and the cost of goods sold account one time at the end of the reporting period, the accounting period, the fiscal year. And in the meantime, during the year, what the company does is that it sets up certain temporary accounts. They set up a purchases account, purchase returns account, purchase discounts account, and something called freight in. And any purchases or any of these other related accounts are just simply recorded to these accounts and then closed out at the end of the year to the proper account, either ending inventory or cost of goods sold. And so essentially, you know, with a periodic inventory system, the company knows what its beginning inventory is for the year, because that is the same number as ending inventory for the prior year. Through their temporary account called purchases, they know how much inventory they've purchased during the year. And so they know how much they have that's available for sale, because beginning inventory plus purchases equals cost of goods available for sale. They don't track inventory during the year necessarily, the outgoing. The way they do this is that they do a year-end physical inventory where they go out and they count particular items of inventory to find out what's still there. The inventory that's still there is assumed to be not sold, right? Or put another way, the items that aren't there are assumed to be sold. And so your items that remain are part of the ending inventory. And so beginning inventory plus net purchases minus the ending inventory account done at the end of the year equals cost of goods sold. Now, there's referring to the physical inventory count. Does it mean that perpetual inventory system companies should not use or not do a physical count? And the answer is yes, they should do a physical count each year. And the reason why is to make sure that their perpetual inventory system is working as it should, and that the physical count comports to the perpetual inventory system count. If not, you've got to make an adjustment to the perpetual inventory system count. Usually because of spoilage, theft, the amount of the physical count is going to be less than the amount in the perpetual inventory account. So you've got to make an adjustment by increasing cost of goods sold and a corresponding credit to inventory, reducing inventory by the amount that's not there per the physical count. So bottom line is the difference is that during the year, management using periodic inventory systems don't know which items have been sold, don't really know what they have in inventory. It's probably not a good way to run a business, but just for the record, GAAP allows either system to be used. Both are considered generally accepted accounting principles. So here we have an example, same example, starting with 120,000 on hand in inventory, buying 600,000. So they've got 720 available for sale. They sell 820, meaning, well, at the end of the fiscal year, they've got 180 still. So what do we have to do? Well, we've got to back out our beginning inventory and replace it with ending inventory, because we have no adjustments made to cost of goods sold during the year. And we've got to make one big debit to cost of goods sold rather than recording cost of goods sold as the sales are made. So, we have here, instead of debiting inventory, we're debiting our temporary purchases account, $600,000. When we make a sale, we just have one entry to accounts receivable and sales revenue. We're not recording the cost of the inventory sold. We're doing that at the end of year with one big debit to cost of goods sold and credit to inventory. So you debit cost of goods sold, you debit your ending inventory for 180,000, you credit the beginning inventory backing that number out, 120,000, and of course you're closing your purchases temporary account for 600,000. So here's a comparison you can look at. Um, Again, probably more companies are going to perpetual versus periodic, but you can see the pluses and minuses. All right, so we have an example here. The Olson Company uses the periodic inventory system. Information for 2018 is as follows. We have sales, beginning inventory, purchases, purchase returns, ending inventory. Cost of goods sold for 2018 is how much? All right, so you're going to take and you got beginning inventory at 340. Your net purchases is 594. So what is that? All right, so you've got cost of goods available for sale of 590. Something's wrong there. 394 plus 340 plus 594 equals 934, and at the end of the period, after doing your physical inventory, you only have 370 left, so you take the 370 and subtract it from the 934. So cost of goods available for sale, or excuse me, cost of goods sold is 564. So that's D. What is ending inventory? Ending inventory is going to, didn't it already tell us what ending inventory is? Well, 340 plus 594 equals 1034. 370. We already said that, right? All right, so what physical units do we include in inventory? Well, certainly it's obvious, hopefully, that the items that the company has in their possession should be included in inventory. But what if you've purchased items at the end of the year, but you haven't received them? Well, bottom line is, if you have title to goods, that you have to include those in your ending inventory, even though you don't have physical possession of those items. And so those are called items that are in transit. To determine whether or not you have title to goods, you have to look at the terms of shipment, and that determines who has title, the buyer or the seller. If the goods shipped are shipped with what are called FOB shipping point terms, legal title is in the hands of the buyer. And what FOB shipping point means is that they have title once the goods have left the manufacturer's docks or shipping point, if you will. Now, if the terms are FOB destination, then title is still in the hands of the seller, at least until the goods that are in transit reaches the destination of the buyer. And the person with title also becomes responsible for the shipping costs as well as the obligation to insure the items during transit. What about goods on consignment? Well, goods on consignment are titled to the consignor, the person who transfers the items to what they call the consignee. The consignee is charged with selling the items, and what they do is receive a commission once a sale is made. But the consignor still continues to own the items that are on consignment with the consignee, and thus is responsible for listing those items on consignment in their inventory. And sales returns we talked about already, so I'm not going to discuss it any further here. So goods in transit, here we have a situation, December 18, the Lothridge Wholesale Beverage Company sold goods to Jabbar Company. The goods were shipped from Lothridge on December 29, but didn't arrive at Jabbar until January 3rd, 2019. If the goods are shipped FOB shipping point, they're going to be titled to Jabbar. Lothridge records the sale on 29th. Jabbar includes those goods in their ending inventory, though they don't have them in their physical possession. If FOB destination, then Lothridge continues to hold them as their inventory, report them as their inventory, and the sale is not recorded until January 3rd, when these goods reach Jabbar. So not only can they not take the items out of inventory, they can't record the revenue part of the sale as well. All right, so here Barrington Corporation uses periodic inventory system at December 31, 2018, end of the fiscal year. A physical count of inventory revealed an inventory of 80,000. the following items were not included in the physical count. Merchandise shipped to a customer FOB destination that arrived that next year. They've got to include those. Merchandise shipped to a customer on 12/29 FOB shipping point. Since they didn't include those, that's perfectly fine. That's what they're supposed to do. Merchandise purchased from a supplier shipped FOB destination and not received till January 4th. They don't list it, so that's fine too. Since it's FOB destination, it's not titled to them. So essentially, they've got to include this $3,000, this first transaction. Now, we talked about net purchases. Because there's more to a purchase, or there can be more to a purchase than simply the invoice price. And so the cost of inventory includes all necessary expenditures to acquire the inventory, the invoice price, but also those costs that bring the inventory to its desired condition, as well as the desired location for use in the manufacturing for sale or use in the manufacturing process. Such costs as freight charges, insurance costs, costs of unloading, unpacking, and even preparing merchandise inventory for sale must be included in the purchase price and added to the cost of your inventory. Now, such things as purchase returns made by the buyer, as well as any purchase discounts that the buyer takes, reduces the cost of net purchases. Now, how you deal with some of these things depends on what type of inventory system you use, perpetual versus periodic. In a perpetual system, the freight costs, for instance, are added to the inventory account, whereas, as we saw with the periodic system, we have these temporary accounts, either called freight in or transportation in this case, that where we add the freight costs to these temporary accounts, and later we add it to the purchases at the end of the year. Now, any shipping charges on outgoing goods, this is freight in, so these are transportation costs to get the inventory to you. Any shipping charges on outgoing goods, goods you've sold, are not included in the cost of inventory. It's just a part of the cost of goods sold, or as an operating expense, depending on the type of item you're dealing with. Certainly, if it's inventory sold, it's going to be part of cost of goods sold. We've already kind of dealt with this purchase discounts when we were talking about these in prior chapters, but we had the gross method versus the net method. We dealt with this when we were dealing with accounts receivable, so it's the same concept. So it boils down to, how do you treat the sales discount, the purchase discount? You know, a sales discount is the same as the purchase discount, It's just, you know, it's a sales discount to the seller. It's a purchase discount to the buyer. So same concept, just different nomenclature depending on which side of the transaction you're on. So if you're using the gross method, when you take a purchase discount, you're going to list the amount of the discount as a credit, and then of course the amount of cash you're going to pay is less than the billed amount. Here, $14,000 is the billed amount, but you're only paying $13,720 in cash. The difference is your purchase discount. With the net method, if you take the discount, it's already been netted out in the payable amount, so it's just a straight debit and credit of two different accounts instead of three. Now in this case, where you have part of the balance being paid outside of the discount date, certainly with the gross method, you're simply going to record accounts payable and cash. But with the net method, if you don't pay within the discount date, since you netted the amount owed, but you're going to have to pay the invoice amount remaining, in this case, of $6,000, you've got to record the difference as interest expense. All right, so here, let's see, we purchased mattresses on August 16, received an invoice of $12,000, terms 2%, 10, net 30. Covington uses the net method to record purchases. Covington should record the purchase at, so it's going to be 12,000 minus 240, so 11,760 is going to be the amount they record this at. I mean, if the same example using the gross method, they're simply going to record 12,000, right? Simple enough. All right, so this just kind of, I'm not going to go over it, but if you want to look at it, it's on page 423 in the book, illustration 8-6. Just kind of goes through and compares perpetual versus periodic system, how they would record certain transactions. All right, so look at that on your own, and I'm going to take a break here, and we will start with the talking about inventory cost flow assumptions, starting on page 420.